Welcome to Iron Financial. We're the place you come to stress test the market's biggest stories and forge a stronger portfolio. I'm your lead analyst. Now look, today we are not talking about another flashy AI software company with a crazy valuation. No. We're talking about the one thing, the only thing, that makes the entire AI revolution even possible. Raw, unadulterated power. And right at the heart of that story is a name you might not expect. Duke Energy. This is a $95 billion utility that has suddenly found itself at the absolute epicenter of a technological gold rush. So the question isn't whether AI is the future, we all know it is. The real question, the one we're here to answer, is whether the company powering that future is a rock-solid investment or a financial disaster just waiting to happen. Let's dig in.
Right, and the core issue is this. Duke Energy, a stock your grandparents probably owned for its sleepy, reliable dividend, is making a monumental pivot. I mean, this is a turn-on-a-dime kind of move. They are planning to spend over $100 billion, that's billion with a B, in just the next 5 years to build the power grid of the future. The question for every single investor looking at this is stark. Are they building an unshakable empire on the bedrock of AI demand, or are they constructing a financial house of cards, one that's going to be weighed down by massive debt and immense execution risk? Is this a once-in-a-lifetime opportunity, or is it a high-voltage trap? That's what we're here to find out.
And I'm your market skeptic. My job here is to find the cracks in that story. We are not just going to read you the company's latest press release. No, we're going to put this company, Duke Energy, through the full Iron Financial stress test. So here's how we're going to do it. First, we have to establish the foundation, this unquenchable thirst for power coming from AI. It's the whole reason we're even talking about this. Then, the lead analyst is going to lay out the bull case, the blueprint for what could be an energy empire. After that, I'm going to take over. I'll be looking for the weak points, the heavy burden of the bear case. And then we're going to stress test the dividend, the very reason most people have owned a utility stock for the last 50 years. Is it a rock or is it a mirage? And finally, we will deliver our verdict. All right, let's get to work.
Okay, let's establish ground zero. None of the numbers, none of the arguments we're about to make matter at all if you don't understand this one fundamental macro tailwind. The AI revolution isn't just happening in the cloud. It's not just about code and algorithms. It's about raw, brute force electrical power. The data centers that train and run these incredibly complex models consume a staggering, almost unbelievable amount of electricity. We are talking about a demand surge that the U.S. power grid has not seen in decades. This isn't some forecast or a wild guess. It is the physical reality of this new technological era, and is the entire foundation upon which Duke Energy is betting its future.
And listen, this is not just corporate hype from a CEO trying to pump his stock. We're talking about the U.S. Energy Information Administration, the EIA. The official scorekeepers, they are projecting that this build-out is going to push American power demand to record highs by 2026. Let me be clear, this is not a small uptick, it's a structural shift in how we consume energy. We're literally moving from a world of relatively flat, predictable energy demand to one of explosive, almost exponential growth, and it's all being driven by this one single industry. So okay, the demand side of the equation, it looks rock solid. But the real question is, can Duke Energy actually capitalize on it without crumbling under the weight of its own ambition?
That's exactly right. And that brings us squarely to the bull case. If the AI power thirst is the bedrock, then you have to think of Duke's strategy as the architectural blueprint for an empire. Management isn't just sitting back and reacting to this trend, they are going all in. They are aiming to become the indispensable power provider for the entire AI age. And they're backing it up with some absolutely staggering numbers. So let's break down the core pillars of this growth story piece by piece.
The first number you have to wrap your head around is this one, $103 billion. That is the size of Duke's 5-year capital plan. To put that into perspective for you, they are planning to deploy over $1 billion of capital every single month for the next 60 months straight. Now, the key phrase here, the one that matters to investors, is fully regulated. This isn't like a speculative oil drilling project or some risky tech venture. This is a plan to build essential, regulated infrastructure that generates a predictable, government-approved rate of return. This is by far the largest plan of its kind in the entire industry, and it is a massive statement of intent. They are not waiting for the future to happen, they are actively building it.
So, what does spending $100 billion get you as an investor? It gets you this number, 9.6%. That is the projected compound annual growth rate for the company's earnings base all the way out to 2030. This is a massive acceleration, over 1.5% higher than their prior plan. Now, for a utility, a sector known for slow, steady, single-digit growth, a near double-digit earnings-based CAGR is almost unheard of. It's like a turtle suddenly sprouting rocket boosters. This is the direct financial translation of that $103 billion investment. They are literally pouring concrete and steel into the ground to forge a much larger, much faster-growing earnings engine for the company.
And this isn't some if you build it, they will come fantasy. They have already come. The customers are already lined up. Duke has already signed 4.5 gigawatts of electric service agreements with data center customers. That figure is up 1.5 gigawatts just since the last earnings call. And these are not just handshakes or vague promises. These contracts have minimum billing requirements and termination penalties, which significantly de-risks this whole forecast. What that means is these tech giants are contractually obligated to pay Duke whether they use the full power load or not. It's an incredible position to be in. And even more stunning, management says their late-stage pipeline is double that size, another 9 gigawatts they're working through right now. This is tangible, it's contracted, and it is accelerating demand.
All of this builds directly to the bottom line, which is what we care about. We're looking at a very clear earnings per share or EPS trajectory. They closed out 2025 with an adjusted EPS of $6.31, which was a solid 7% growth. For 2026, they're guiding to a midpoint of $6.68. But the real story here is that long-term target, 5% to 7% annual growth, and they've extended it all the way out to 2030. Now here's the kicker. The CEO, Harry Sideris, has expressed high confidence, and I mean high confidence, in delivering in the top half of that range, so think 6% to 7% growth starting in 2028. And why 2028? That's the year the new data center loads really begin to ramp up and hit the grid. We are looking at a clear, defined inflection point for this company's earnings. And to anchor this entire bull case, you just have to look at the words of the CEO himself. The fundamentals of our business have never been stronger. Now, this is not the cautious, measured, boring language you typically hear from a utility executive. This is a statement of supreme confidence. They believe they have the plan, they believe they have the regulated framework, and they know they have the contracted demand to execute this massive transformation. So the bull case is crystal clear. Duke is evolving from a slow-moving, predictable utility into a high-growth infrastructure titan. And it's being powered by the single biggest demand driver of our generation.
Okay, that is an impressive blueprint. I'll give you that. But here at Iron Financial, we know that the most ambitious blueprints are often the first ones to show cracks when you put them under real stress. So it's time to stop admiring the architecture and start testing the structural integrity of this thing. While that growth story is compelling, it carries an absolutely immense weight. And now, we need to see if the company's foundation is actually strong enough to bear that load. It's time we start identifying the potential cracks in the armor.
The first and most obvious stress point is the balance sheet. And the number you have to focus on is 1.54. That is Duke Energy's current debt-to-equity ratio. Now look, for a capital-intensive business like a utility, having leverage is normal. But a ratio this high means the company is already carrying a significant amount of debt on its books before it even begins a $103 billion spending spree. Think of it like this. You're taking out a massive new construction loan for a mansion, but your existing mortgages on your other properties are already stretched to the absolute limit. Can this company truly handle the burden it already has while simultaneously taking on the heaviest financial lift in its entire history? That is a very serious question.
So how in the world are they planning to finance this monster plan? Well, the plan breaks down like this. You see the huge $103 billion need at the top. You see their internal target for cash flow to debt, which they hope to get to 15%. But look at that third line. That is the one that should get every single shareholder's attention. $10 billion in planned equity issuance between 2027 and 2030. Let me be crystal clear about what this means. It means they are going to sell new shares of the company. It means they are going to dilute the ownership stake of every single person who currently holds the stock. To fund this massive growth, they are going to be slicing the company pie into more and more pieces, and your slice is going to get smaller. That is the non-negotiable costs of admission to this growth story.
And beyond just the financing, there are some really serious operational risks here. Let's call them what they are. They are potential fracture points. First, you have massive execution risk. A plan of this scale has countless moving parts. One delay, one cost overrun can have a domino effect across the entire project. Second, and this is a big one, their success is almost entirely dependent on getting favorable outcomes from state regulators. That is not a given. Third, we still live in a world of fragile supply chains. Getting specialized equipment like giant turbines and transformers on time and on budget is a major challenge. And finally, and this might be the most important of all, there's the political risk of customer affordability. How do you spend $103 billion without sending your customers' electricity bills skyrocketing and creating a massive public and political backlash?
And that brings me to the absolute core of the bear case.
The entire bull thesis, all those rosy projections, it all rests on the assumption that state regulators will just rubber stamp the rate hikes needed to pay for all of this investment and generate that 5 to 7% EPS growth. But here's the thing. Regulators have a dual mandate. Yes, they need to ensure the utility is healthy, but they also have to protect consumers from excessive costs. As those monthly bills start to rise, the political pressure on those regulators is going to mount. So I have to ask, is the promise of future regulatory approval a truly solid foundation for an investment of this magnitude? Or is it a huge variable that could shift under political pressure, cracking the entire financial structure of this company?
That is the central tension right there, and it leads us directly to our next stress test, the dividend. For generations, the dividend has been the bedrock of any utility investment. It's the promise of a steady, reliable, almost boring income stream. But with Duke embarking on the most aggressive growth plan in its entire history, we have to ask a tough question. Is that bedrock as solid as it seems, or could it become a mirage in the face of these unprecedented demands for capital?
Now, to be perfectly clear, Duke's history here is impeccable. It's flawless. This company has paid a cash dividend on its common stock for 100 consecutive years. Think about that. Through world wars, deep recessions, market crashes, inflation, you name it, that check has arrived in the mail. This history is the core of the company's value proposition for millions of income-focused investors. It is a powerful, powerful testament to stability and reliability. But history is not a guarantee of future results, and the current reality is this. Duke's dividend payout ratio sits at around 67%. Now let's break that down. That means for every single dollar of profit the company makes, 67 cents goes right back out the door to shareholders as a dividend. That leaves only 33 cents to be reinvested back into the business. My question is this: in a period where the company needs to fund a record-breaking, mind-boggling $103 billion capital plan, is a 67% payout ratio truly sustainable? Every dollar that's paid out as a dividend is a dollar that cannot be used to fund new power plants or grid upgrades. There's a fundamental cash flow conflict brewing right under the surface here.
The current annualized dividend yield is about 3.5%. And for an income investor, on the surface, that's an attractive number. But here's the critical question you have to ask yourself. Is a 3.5% yield adequate compensation for the entirely new risk profile we're being asked to take on? You are no longer just getting paid for the stability of a regulated utility. You are now being asked to underwrite massive execution risk, huge regulatory uncertainty, and $10 billion in future shareholder dilution. The trade-off has fundamentally changed. The yield remains, but the risk it's supposed to compensate you for has dramatically increased.
All right. We have laid out the massive macro tailwind of AI power demand. We've built the bull case for an energy empire, and we've hammered on the heavy burden of the bear case. We've put the dividend itself through a stress test. Now it's time to put all the pieces together and deliver the iron financial verdict. Is Duke Energy an opportunity, a trap, or is it transforming into something new entirely?
Okay, the structural strengths are undeniable. Let's be fair. You have unprecedented, contracted, real AI-driven demand. You have the largest regulated capital expenditure plan in the entire industry, which directly fuels strong earnings per share growth projections. These pillars are solid steel. But the potential fracture points are just as real and just as dangerous. A high debt-to-equity ratio of 1.54 creates a very heavy burden. The execution and regulatory risks on a plan this size are simply enormous. The planned $10 billion in shareholder dilution is a guaranteed cost to every single existing investor. And the entire profile of the company is shifting away from predictable stability to a much more volatile, high-growth model.
So you can't evaluate Duke Energy using the old utility playbook anymore. You have to throw it out. It just doesn't fit. Our analysis leads us to a new classification. We're calling it a growth utility, or a growtility. This is a company that is fundamentally transitioning right before our eyes. It's moving away from being a primary vehicle for stable income, and it is morphing into an investment that prioritizes aggressive, long-term, high-magnitude earnings growth. Growth that is funded by absolutely massive capital expenditure. The old metrics, the old expectations, they just no longer apply to this company.
So our final verdict is this. For decades, you bought a stock like Duke Energy for the dividend. You bought it for stability. You bought it so you could sleep soundly at night. That is no longer the primary reason to own this stock. Buying Duke Energy today is a high-stakes, aggressive bet on one thing and one thing only, their ability to successfully build the power grid for the AI revolution. The dividend is now a secondary part of the story. The primary story is growth, execution, and, yes, a whole lot of risk.
We are going to leave you with this final thought. The AI revolution is not a fantasy. It is real.
and it will be built on a foundation of concrete, steel, and trillions upon trillions of watts of electricity. Duke Energy is positioning itself to be that foundation, and there is immense potential in that strategy. But building an empire is risky, and it is incredibly expensive. So the question every investor has to ask themselves is not whether the demand is real. We know it is. The real question is, are you willing to shoulder the heavy burden of debt, dilution, and execution risk for the chance to own the very foundation of the future? That's a question only you can answer. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.